Accounting for issuance of shares. When a business issues common shares for cash, it receives cash from investors. The cash is debited for the amount received, and the common shares account is credited. The same thing happens when preferred shares are issued, where the corporation receives cash from investors and issues preferred shares to them in return. Preferred shares account is credited in that case. Sometimes a company can issue shares for other than cash. For example, an investor can trade building for common or preferred shares. The value of the transaction should be recorded by the fair market value of the building or the shares, depending on which of them is more reliably measured. Assume that the shares are not traded and an appraiser valued the building for $1 million. The transaction is recorded by this value by debiting the building and crediting the common shares. Now assume that the shares are traded on the stock market and the price of the shares is known. The building will be valued by the shares in such a case. So if the shares are traded on the stock market for $90 and the company issued 10,000 shares for the building is worth $900,000. Still, the building is debited and common shares account is credited for such an amount.